Would you pay money now to save money later? We're talking about buying points versus not buying points on your next home mortgage. So this is the real numbers. This is real data to help you make real decisions. I'm Joe Harris. I'm the CEO over at Morgan Financial, and we're going to get into points. Now, I've heard this for years. I'll talk to a borrower and they'll say something like, I don't want to pay points. And to me, points are just a function of math. Mortgage points are upfront fees paid in order to lower your rate. They are a function of math, and 1 point equals 1% of the loan amount. Now, in the past, people thought that was more of a junk fee and it went right to the lender and it didn't go for a reason. But the reality is you're paying that money up front to get a discount on the interest rate. And so again, 1 point is 1% of the loan amount. So if it's a $300,000 loan, 1 point is $3,000. So what does 1 point get you? As a rule of thumb, 1 point usually gets you a lower rate by about 0.25%. Now, that's not always typical, and this can definitely change depending on the day, the hour, the month, the year, the lender, the market, the loan type, the pricing for that day. It's a lot of different factors that go into it. But as a rule of thumb, and for our purposes today, we're going to talk about 1 point lowering that interest rate by about 0.25%. Now, I will tell you this. If 1 point gets you 0.375% or even 0.5%, that's like a sale. And so you want to pay close attention to those types of deals that are out there. So let's talk about comparing buying points versus not buying points. So we're going to talk about same loans, multiple options, and very different outcomes. So let's talk about a couple of scenarios. Let's talk about a $500,000 loan. Big loan amount, but we're seeing more and more of ones that size these days. And so we're going to talk about a no point option, a 1 point, and a 2 point. And there's a couple different factors here. We're going to talk about what that does to the rate, the points that it costs, or the money you pay up front, and how it changes your payment and what the savings would be. And then we're going to bring in the concept of a break even. So let's get started with the no points option. Let's just pretend. And by the way, these are all for this educational purposes. These aren't today's rates. I'm not quoting you rate, and I'm certainly not guaranteeing you any of these rates if you call into Morgan Financial. If you want to get your rate specific to you for today, call Morgan Financial. We have information in the description and the comments down below. We'd love to help you out, especially if you're in Florida. But with that being said, let's look at the no point option. So it's 6%, no points. Your principal and interest payments, $2,998. And let's say you pay 1 point. You get your rate lowered by 0.25%. It costs you $5,000 up front at closing, and your payment drops to $2,918. That's an $80 monthly savings, and the break even on that is 63 months, or just over 5 years. And let's say you paid 2 points, lowers your rate to 5.5%. The cost about $10,000 up front, and your payment lowers to $2,839. That's about $159 a month savings. Again, your break even is 63 months from paying versus paying no points. So let's move on to the second little example here. Is sometimes points don't cost the same amount. So sometimes, like I said, if it only gets you an eighth more, or, 1 point might get you a quarter, and then the second point might only get you an eighth more than that, it really changes the dynamic. So in this scenario, you have 2 points being paid, you only get 5.625, which is only 0.3% better. And that cost is still $10,000. The payment only goes down by $120, and the payback's 83 months. So big difference here. So let's talk about the break even. The break even is your payback period. So shorter break even, it makes for a much easier decision. If the payback period was like 5 months, it'd be a no-brainer. If it's a longer payback period, like 100 months, that's a lot more risk, because are you going to be in the house long enough to really enjoy the benefit that you paid for up front? And selling or refinancing too soon can erase all of the savings. So, if you think rates are going to significantly decrease in the short term, then you might not want to pay points. But the fact is, and we've seen this over the last couple of years, is no one really can tell the future. Who knows? Regardless of what people say about the future, rates are going to go down, they're going to go up. No one really knows. No one really knows. So always compare the cost today versus the savings over time. So the break even really boils down to the cost of the points divided by your monthly savings, and that gives you amount of months that would take to technically break even. Even though you're enjoying that benefit every single month, you have to take the cost versus the benefit, which is the monthly savings, and that gives you that month breakdown. So example would be that $5,000 divided by $200 a month savings would be 25 months break even. So if you don't think you're going to be in the property for 25 months, I wouldn't buy the points. If you think you're going to be there for 10 years, it might make sense for you to buy down the rate. So points may work for you if you plan on keeping the loan long term. Like if you think you have to move, sell the house, upsize, downsize, right size, whatever, you probably don't want to buy something that you might give up the benefit by selling that house in the short term or refinancing in the short term. If it may work for you if you have extra cash available, or maybe your transaction allows for extra cash if the seller is willing to pay money towards your closing costs, prepaids, and escrows. This is something that might help benefit you significantly over the term of that loan. If they're going to pay for that $5,000 and you see a benefit of $120, $200 a month, that might be a good usage of the seller's concession. Extra cash is available. Monthly savings makes sense. Again, if that money up front is not as important to you as the savings down the road, it might make sense to do that. You're not planning on refinancing soon. It might make sense, but if you're planning on refinancing in the short term, probably won't make sense. So if you're planning on selling in the near future, plan on refinancing soon. If money is for closing is super tight and there might not be seller concessions, you don't want to deplete your savings, and the savings don't make sense for you, the points may not be the right way to go. So common mistakes borrowers make is only looking at the rate. You can't separate rates from fees. You have to look at what the rate is and what's the cost of the rate. For years, people would call in and say, "What's your rate?" And the reality is the rate is whatever they want. It could be as high or as low as they want. It just depends on how much they're willing to pay for it or how much they're willing to get paid to take a higher rate. Skipping the break-even math is a mistake. A lot of times loan officers or big boxes will say, I can get you, they just don't even give you the option. They say, listen, we're going to get you a 5.75% interest rate to get the client, the borrower, all excited. And then they get, they see all these fees on the loan estimate or even at closing. And they're like, well, what are all these fees? And the loan officer is like, well, that's the cost to get the rate. Well, they never explained that. You always want to go over what the rate is, what's the cost to get it, right? And a common mistake people make is forgetting about the cash to close. Look, buying points costs something. Closing costs cost something on a loan. You want to make sure you're looking at all these things. What is the rate? And how much does it cost me to get that rate? Because a lot of lenders might hide fees somewhere on their loan. Granted, it'll be shown on an LE, but it all goes into the cost of getting that loan. You can't always assume more points equal a better deal. Sometimes, like we showed, sometimes by paying 2 points, you might get an added benefit. Maybe sometimes 1 point might get you an added benefit, but sometimes it doesn't. So make sure you look again at that break even. What's the cost? What's the benefit? The timeline is also very important. A lot of people put a lot of stock in, I want the best rate. I want the absolute best rate. But sometimes it might make sense to take a higher rate. Believe it or not, if you're going to leave the house, you have orders to PCS to a different state, permanent change of station, if you're going to transfer with your job, it might not make sense to pay points. It might make sense to go the opposite way, which people don't always think about, is taking a higher rate and getting the lender to give you a closing cost credit. It's the opposite of points. You're getting, instead of paying to get a lower rate, you might actually be paid to take a higher rate. And if you're going to be in the property a short amount of time, like they say in Vegas, you might beat the house. So ignoring your timeline is a big mistake that some people make. So in recap, buying points is more than just the rate. Points lower your rate, but they might increase your cash to close. So you got to remember, factor in what's it cost and what's my benefit. The break even is going to tell you when the savings catch up. So even though you're saving that every month, if you saved this much money every month, eventually you're going to pay back that upfront investment. Your timeline matters most. If you know you're going to be in the property long-term versus short-term, It might make more sense to pay points if you're going to be in the property shorter term. It might not make sense to pay those points. So you always want to compare the rates, the cost, the monthly savings, and calculate that break even. If you need any help with this math, we're here to help. So remember, running your numbers. We have great calculators on our website. The links are down below and in the description to morganfinancial.net. I think there's a / mortgage-calculators. If you're buying or refinancing in Florida, we're here to help you. We'd love to talk to you. Our contact information is down below. And that's it with the real numbers. We'll see you next time.